What's up, happy people? This is BGFAX, your mentor, and welcome to yet another video. Like I promised, guys, I'm going to be sharing a whole lot of stuff. I'm going to be sharing amazing information to make sure that you and me are trading, are enjoying our trading journey, and making sure that beginners and also those who are experienced can get something out of this, can get value out of this content, right? So, guys, like we always do, please, if you are here for the first time, please like, share, and subscribe. Click the subscribe and also click the notification bell so that when we upload the next video, you will be notified, right? If you are an old member, you know what to do. Like, share, and subscribe so that we can get our channel going. All right. So, guys, today I want to talk about a very much sensitive topic that a lot of traders, they shun, they don't want to talk about it. And those who talk about it, they don't practice it. And nobody wants to admit that it's very much difficult to manage your risk when you are a trader, right? So today I just want to focus mainly on the volatility indices, right? So we all know that it's very much easy to calculate your risk when you are dealing with your stocks, when you are dealing with your Forex, when you are dealing with your, excuse me guys for the background noise, my office is located or situated right behind the freeway. So yeah, so once in a while, you're going to hear the sound of supercars and all these machines, right? So let's continue. So as I was saying, when it comes to your Forex and your stocks trading, it's very much easy to calculate your risk. There are so many risk calculators that you can find in the markets that you can just easily plug in your details, plug in your inputs, and then automatically it can calculate for you, right? So when it comes to synthetic indices, not a lot of people know how to do that. This is why a lot of people blow accounts. And also one thing that I need to let you know, guys, is that this is not by any chance financial advice. Should you need financial advice, look for the professionals, professional people in that field, right? So this is basically for educational purposes. And if you want to use this knowledge, if you want to apply this in your trading, make sure you accept the risk. Okay. All right. So also, you must know that trading is a risky business. You need to know what you're doing and you need to accept what you're doing, right? You need to take responsibility, right? Okay, so guys, synthetic indices, right? So as you're looking at this chart, I'm just going to, I don't know if you can see my mouse right here. I think you can see my mouse right on the far right corner, right on this tab with price levels. These price levels are very much confusing based on the index that we are looking at. Some we have like numbers like hundreds of thousands, some we have millions, some we have tens of thousands. Unlike in Forex where we have 4 digits or 4 digits and 5 digits after the comma, like it's very much easy to calculate the pips and to know the pip value and everything, right? So I'm just going to I'm just going to share something before I go, right? Before I continue, okay? So let's start by doing this, right? So as a trader, right, it's very, very important to always have a clear and defined risk percentage, right? You must know what you are willing to risk before you enter into a trade. Never just enter in there like randomly and you don't know what you're doing. You are going to blow a lot of accounts. And when you do that, you are frustrating yourself, you are emptying your pockets and you are delaying your journey. You need to know, for example, let's say you have $100 account. You can say I'm risking 2% or I'm risking 3% or 5% of my account, or you can pick to say I'm going to risk $5, right? I always encourage people to risk less, especially when they are beginning, especially when they are starting. But once you feel like the ball is rolling and you know you've seen that your consistency is very much like you can actually tell that I have a very good win rate and a consistent strategy, and also the way you're trading, you can then maybe pump up your lot sizes. But obviously you do it knowing exactly what you're doing, right? So let's assume you have $100 account, right? If you say I'm gonna risk 5%, it's going to be $5, right? So before you trade, you know that I'm going to risk $5. So what it means, like I always tell people, that whenever you open a trade, no matter how good you are, no matter how best your strategy is, that trade, there's 50-50 probabilities. Either you're going to win that trade or you're going to lose. So it's 50% win, 50% lose probability. Say that you win that trade, you will not. And when you do that, when you enter into a trade, you no longer have control over the outcome, right? It's just you now waiting. But what you can do is you can try to increase the odds of you winning that trade before you even take that trade. But once you take that trade, it's now you sitting down and managing your trade and waiting to see what the market is going to do. You no longer have control at that moment in time, right? So what you can control is you can control your risk, okay? So if you say, let's say, for example, I'm willing to lose $5 or 5% of my initial capital, right? So you're going to put 5% on the line, and then you say, okay, $5 is what I'm willing to lose, right? So I want to say something here. Many people, they literally like calculate the risk, right, on paper, and then they place the trade, but in their heart, they have not yet accepted that I'm willing to lose the money. Like they're doing it on paper, but not like in real life. They are not really willing to lose that money. How do we see that? We see that by when you place a trade, you're constantly monitoring your trade. You can't even sleep. Some of you guys, you're watching each and every candle that is painting on your charts. You can't even go to eat or bath simply because you are not accepting the risk, right? So these are signs to see that you are risking what you're not willing to lose. But if you're willing to lose something, you are not very much attached. You're not married to it. You just place your trade and then you leave, you go and you do something else, okay? And you do something else, right? So make sure you understand what it means to risk what you're willing to lose. Let me just fix these guys. All right, so this is my Instagram handle. Should you need to talk to me, I'm always there to talk to people. All right, so this is what many people are not like willing to accept. Accept your risk first, all right? Or don't trade what you're not willing to lose. In other words, don't over risk your account. Don't blow your account, right? Make sure you give your account enough time, enough room to breathe, and also enough time to grow as a trader, okay? Now, let's assume that you've calculated your 5% of $100, which is $5 that what you're willing to lose, right? So another thing that I always want to tell people is that risk management is not all about calculating a risk. It's the whole process of you analyzing your charts and also having the perfect entry. So only take a trade that meets your trade entry criteria or your criteria that follows your trading plan, right? It's part of the risk management. By you avoiding a certain trade, you're actually managing your risk. By you taking the best trade that meets your criteria, you're actually taking the best trade as well. So make sure this is also part of your risk and management plan, right? So another thing is, when you enter into a trade and you see that, okay, so this trade is running against me, always have rules set aside to say, if I enter into a trade and it seems not to go in my favor, when do I cut losses short, right? So make sure you always cut your losing trades short and you let your winners run. This is how you make money, guys, right? And then also the break-even rule, right? I'm going to demonstrate here, right? Always make sure you apply this principle. This will protect your money and also your winning trades. And also taking partial profits, guys. I always tell people that whenever you're trading, always pay yourself, okay? When you enter into a trade, even if you have a target of 1:20, 1:10, 1:5, whatever you're targeting, always pay yourself, because we don't know, in as much as we try to predict the market and where it's going to go and have our targets. That does not necessarily mean that the market is going to get to your targets. So you need to pay yourself so that you don't feel like I lost the opportunity of making money when the market comes against you and wipe out all your profits, which is what many people are struggling with, right? So make sure you do that. All right. So with me here is just a typical chart. The red line here, you can just call it, it's a typical chart, right? So let's assume you want to enter here, right, by this black line, okay? So you're going to enter, place your trade, and then you are going to place your stop loss, right? So this is just a trading view tool that will help you to analyze. So the red portion is the stop loss area, and then the gray part is the profit area. So if you buy here, to say we are buying here, if the market goes against you, it's gonna hit your stop loss at this price level, right? At this price level. If price moves to your profit, it's gonna hit your tip, like a final TP at this price level. So you must be able to know how to do this. So I always tell people, never take a trade, right, that has got a risk to reward of 1:1, right? Make sure all your, let me type this out for you guys. Make sure your minimum risk to reward, right? Your minimum risk to reward is always 1:2, right? This is minimum. So what it means is you can go for 1:2, 1:3, whatever. For those of you who do not understand what we mean is that, what we mean by risk to reward, what we mean is that, let's assume that you risk $5, right? So never take a trade that is going to give you $5 in profit. You need a trade that will give you $10 or $15 or more, or $20 or $50 when you risk $5. You don't want to make the same amount of money that you are risking. You want to make more. That's how we survive in this business. That's how your account is going to grow. So at one point, you're going to lose. I always tell people that if you have a 40% win rate strategy, right? A strategy with a 40% win rate, even if you lose like you lose 60% of the time, the 40% of the time you are going to win. When you have a good risk to reward, you are still going to be profitable. So I personally like 1:3 and more. If possible, I can hold my trade. So when you see a winning trade, try to take some partials. What we mean by, well, let me start by break even. Let's assume that the market is moving, right? So the market moves with the equivalent stop loss distance. This is one the majority of people do, which is also like a good thing to do. Let's assume that the market moves with the same exact distance of your stop loss in your favor, like in the profit side. So what you simply do is you move your stop loss and then you lock your entry. This is what we call locking your entry. Why is it important? It means that once you take this trade, you are eliminating risk, you are removing risk off the table. So which means if you get another opportunity in the markets, maybe on another pair, you can still open another position because you have eliminated the initial risk, the $5 that you had risked earlier, right? So by so doing, you are making sure that you protect your market, and you can go do whatever you want to do without even thinking about or worrying about, you losing the trade, right? It's very, very important, okay? Once the trade moves in your favor, so this is what I always tell people, like when the trade moves maybe, let's say close to 1% or 2%, or maybe half of, you see this region from A to B, maybe if the trade moves like 50% of that region, 50% of that region, like this region, what you can do is you can take some partial profits off the market. Let's assume that price is moving and you had opened like a lot sizes of 0.50. You can close maybe 0.30 off the table. You can take some partials, you can bank something. Remember, when a trade is running, you have equity and you have your balance, right? So the money is always recorded. It's only recorded to your balance when you close some profits. So you need to close some profits such that, why is it important? If the market goes against you, or maybe comes back to hit you at break even, you would have banked something, right? This is very important. This is what I call always paying yourself, okay? All right. So now that we understand this, okay, break even and taking your partials, it's very, very important. So I'm not going to go much more deeper. If you want deeper, you can click in the link description below to check out our free Telegram channel. And those of you who would want like mentorship, we've got an amazing mentorship program that we run where we take beginners right from the beginners level to the advanced level, right? So you also see our website. You can go and click and check and see what we are all about, right? So let's continue, guys. Now, I'm now focusing on how do you calculate the risk, the percentage on the VIX or synthetic indices, right? This is where I wanted to go, and I made sure that I had to lay like a little bit of foundation when it comes to your risk management. It's not just about calculating, it's about the whole process, right? So how do you calculate? Okay, so this is how you calculate, guys. Your risk percentage or your risk or stop loss value in terms of money, right? This is very much confusing when it comes to trading synthetic indices, and a lot of people, they don't even know what to do. Okay, so what do you do? So this is what you do, guys. It's entry price minus stop loss price, and then you multiply it by the lot size that you see, like the minimum lot size or whichever lot size that you see on your platform. I'm going to demonstrate these guys on the charts, right? So once you get your answer, you're going to round it off to 2 decimal places after the decimal comma, after the comma, to match up the current decimal places, right? So you then use your proportion to get your lot size. I'm going to demonstrate these, guys. I know this is quite confusing for a lot of people. Okay, so I'm going to share a screen, and then we get to demonstrate right on the charts and show you exactly what I mean, right? Okay, so with me here is V10. With me here is V10, which I just randomly like opened. So what I'm going to do is I'm going to dock. Let me just remove the dock. All right. So let's do this. Let's do this. Let's view the toolbox. Okay. All right. Beautiful. All right. So what we are going to do is I want you to study something here. On your, let's say you open a random position, right? I just want to like kickstart this. When you say you just buy or sell any random pay at any lot size, like this was 0.30. So you have your instrument, which is volatility 10 index. Then you have the ticket. This is for the broker, and then the time which that you opened, and then you have the trade type, excuse me, which is a buy. And then you have your volume, which is 0.30 lot sizes. Then you have the price. The price, this is the price where you opened the position. This is the price where we bought, okay? Where we opened to say we are buying. And then the stop loss is this one, 0.70.688. Then you obviously have a TP. Let me just drag and then just put a TP, right? You have a TP, which is 0.98 right here. And then we have the current price, which is changing right now, which is 60.77 like, as you can see, it keeps on changing. As it is changing, also the profits based on the lot size is also changing, right? So I want to show you how we got to this price level, okay? So what I'm going to do is I'm going to pull out my calculator, and I hope it's going to show. I hope it's going to show. If it doesn't show, guys, I'm just going to work with the numbers that I'll show you, okay? And then you can maybe use your calculator just to see what is happening. Okay, so we want to see how we go to this number 0.50. So here's what you do. You subtract the what? You subtract the current price. You subtract the current price, which is 6.076. you subtract the current price. You can also do this with me, okay? Which is 6.6076.189. You subtract it from the current price, right? You subtract it from the current price. Obviously, it's gonna be fluctuating, right? It's gonna be moving. So we'll just pick a random number, 6076 point. Currently, it's what? 56, right? So what you're going to do is you're going to get a number either with you're going to get a number either with a negative sign or positive sign. So ignore the negative sign. That's not what we are interested in, right? So here I got 0.371, right? So the number that you get, you then multiply it by the lot size. You see this lot size, which is 0.3. You multiply it by 0.3. So what you're going to get is you're going to get 0.113, right? You're going to get 0. Let me just annotate it. You're going to get 0.1113. As you can see, the number keeps on fluctuating here, right? But I think you get the idea, right? So I'm gonna pick the round off the first two decimal places after the comma. So we have 0.11, right? This I ignore. So what it means is at that particular time when I calculated, we had a profit of 0.11. So what it means is that for that movement of price with that minimum, with that lot size of 0.3 from the entry to where it was 11 cents. Okay, right. Now, how does it help us when it comes to then now calculating our profit, our risk percentage, right? Why is it so important? Why is it so important, right? Once you know this, it's very much easy for you then now to say, okay, so if I am buying, right? If I am buying, I want to show you something. So let's say, for example, you want to buy at this price level. So here we bought at this price level. So allow me to just put this so that we can pick the numbers. And then we say we are going to be putting a stop loss right here, okay? We are going to do the same thing, right? We are going to say the entry price. We are going to say the entry price, which is what? 60676 point. The number is here, guys. 0.117. We subtract it from this one, which is 6070.571. You're going to get a number of 5.546. You're going to get 5.546. You're going to get 5.546, right? This is the answer that you get, this one, okay? Let me just do this. Let's make it 14. Beautiful. So you're going to get 5.546 as your what? As your pippage, right? Is your pips. The difference between the entry price minus stop loss. You're going to get the number of pips within your stop loss region. Okay. Now, you then pick like any lot size, or you can say that the minimum lot size here. As you can see, we have 330. So you then multiply this number 5.56, right? 5.546. You multiply this number by 0.30, right? Remember, we said the answer that we get from subtracting the entry price, the current price movement, right? Here we're just using the stop loss. So the answer that comes there will be the monetary value, right, of that stop loss. So what it means is that I'm gonna get an answer of 1.6638. Okay. So what I do is, remember I said I want to use the minimum, like I want to round off to 2 decimal places after the comma. So I'm focused on this. So if I do my mathematics well, it's gonna be $66. So what it means is that if I use this lot size, which is 0.30, I'm gonna get what? For my stop loss distance, I'm gonna get $66. I'm gonna lose $66. Okay, so this is just the simple calculation that you do. Now, for someone who's saying now, but what do I do if I want to then now enter? So you just randomly like pick, just put lines on a chart, right? Now that you know how to calculate, just put lines on a chart to say, okay, so I'm going to be entering here, and then I'm going to be putting a stop loss here, and then pick any random lot size, either a minimum one or any lot size that you're going to use, right? You'll see why it is important. Okay. Once you get that, once you understand that, you then now able to calculate whatever you want to calculate. So let's assume now is you have an account of 1,000. Let's say your account balance is 1,000. This is your account balance, okay? So remember what I said is, before you take a trade, you must be able to know what you're willing to lose in your account. So let's assume that you're willing to lose 5%, okay? You're willing to lose, let's say, willing to lose 5%, okay, of your account. So this is equivalent to, we want to know the monetary value of 5% of $1,000, right? So what it means is that you are saying that you're willing to lose what? $50, right? You're willing to lose $50 of that account, right? You're willing to lose $50 of that account, right? $50 of that account, right? So this is the monetary value. Now, how do we then get the lot size for us to be able to risk this? So this is where it's gonna confuse a few people, but I'll try to make it simple. Here we then use simple mathematics, direct proportion, right? Simple mathematics, direct and indirect proportion. So what we mean is that what you do is, I'm gonna teach you a simple formula, right? Let me see how I can demonstrate here. So let's say, so we are saying if, so you say if, right? It's simple mathematics. I know a lot of people hate mathematics, guys, but if you are a trader, at least try to learn. This is simple algebra, simple mathematics, primary school mathematics, right? So what you do is you say if $66, right? If $66 is directly proportional, because we are saying that $66 is made out of us using 0.30 lot size, right? So, oh, I don't know where I edited this. Let me copy, guys. It's supposed to go here. Copy. Right. Beautiful. If $66 gives us what? 30. $66 is made up of 0.30 lot size. The question is, what of, so you match up the money with money. So what of $50, right? What of $50? So I'm gonna remind a few people here. What of $50? Oh, I keep on editing on the wrong. So what of $50? So if $66 is equivalent to 0.30 lot size, what of $50? So I'm gonna remind a few people here their mathematics, direct proportion and indirect. So this is what happens. If you see that you are trying to do this type of mathematics, right? And there is a bigger number at the bottom here, which is $50. That bigger number, right? If you see that you want to do, excuse me, guys, just hold on a little bit. All right, so let's continue, guys. Sorry about that. So let's say if you see a number, you see we are saying $66 is equivalent to 0.30. So what of $50? So obviously, logically speaking, just simple logic, it tells you that if we are willing to risk $50, it's gonna be a bigger lot size. In other words, it's gonna be more, right? I'm just taking you back into simple basic algebra. So it's gonna be more, right? If you remember, well, we used to do this, right? It's gonna be more. So when you have a figure that is more than the initial one, this one, the bigger one is gonna go at the top. So what it means is you will now have $50 divided by $0.66 times 0.30. So you're going to get a number of 9036. 9036. In other words, you're going to get 9 lots, right? You're going to get nine lots. Okay. So when you open when you want to trade now, you can say that, okay, so I'm willing to lose $50, so I'll open a position of 9 here. You go and punch 9 here. Or what other people like to do is they can divide these 9 lots into maybe 9 times 1 lots, or some will say 18 times 0.50 lots. Like, it all depends with what you want. So guys, I hope you got the hang of this. So just go and try to see how you can play around. Once you understand the initial basic calculation, maybe you can then now play around with another way. So guys, I don't know what you think. Just write something in the comments. What do you think about this way of calculating? If there is a way, guys, that we can also calculate, you can share with me in the comment section to make sure that we improve each other. So thank you so much, guys. Don't forget to like, subscribe, and share the videos as we go. And also don't forget to click the links in the description below. We have a free Telegram channel where I teach people how to trade synthetic indices, Forex, stocks, and cryptocurrencies, and a whole lot of other markets as well, right? So thank you so much, guys, and have a beautiful, beautiful day. See you next time. I am BGFAX, your mentor, and I'm out.